Welcome to today's video, where we delve into Chapter 15 of Fundamentals of Financial Management, exploring the critical topic of required returns and the cost of capital. Let's jump right in. Section 1, Creation of Value, Industry Attractiveness. How appealing and promising is the overall industry or market for businesses? Competitive advantage. What sets a company apart, giving it an edge over others in the market? Overall cost of capital, cost of debt. The cost a company incurs to borrow money. Cost of preferred stock. The expense associated with using a specific type of financing. Cost of equity. Dividend discount model approach. The cost of using equity, calculated based on expected future dividends. Cost of equity, capital asset pricing model approach. The cost of equity calculated using a model that considers risk and return. Cost of equity before tax, cost of debt, plus risk premium approach, determining equity cost by factoring in the risk associated with debt. Weighted average cost of capital, the average cost of all financing sources adjusted for their proportion. Some limitations, recognizing the shortcomings or constraints of these cost calculation methods. Rationale for a weighted average cost, understanding why the weighted average cost is a meaningful metric. Economic value added, EVA, a measure of a company's financial performance considering its cost of capital. The CAPM for projects and groups. Capital asset pricing model, approach to project selection, using a model to guide the required rate of return for specific projects. Group-specific required return, determining the needed return for a particular group within the company. Some qualifications, acknowledging certain conditions or exceptions in the application of CAPM. Ascribing debt funds to groups. Allocating borrowed funds to specific groups or segments. Evaluating project risks. Risk-adjusted discount rate approach. Adjusting the discount rate to reflect the level of risk associated with a project. Probability distribution approach. Considering the likelihood of different outcomes when evaluating projects. Contribution to total firm. Risk firm portfolio approach. Assessing how a project contributes to the overall risk of the entire company. Conceptual implications. Exploring the theoretical consequences or considerations related to project evaluation.